There's a financial cliff coming that most people have never heard of, and unlike the last banking crisis, this one isn't hiding in exotic derivatives.
Right now, trillions of dollars in commercial real estate loans are approaching their maturity dates, and they were financed at interest rates from a world that no longer exists.
Here's how it works. Commercial real estate loans aren't like your 30-year mortgage. Most are structured with a 5, 7, or 10-year term.
That means at the end of the term, the borrower doesn't just keep paying PREB. They owe a massive balloon payment, and they typically refinance into a brand new loan to cover it. For over a decade, that refinancing was easy. Rates were near zero, lenders were generous, and property values kept climbing. Think about an office building that took out a loan in 2019 at a 3.5% interest rate. Back then, the math worked. Rents were healthy, occupancy was strong.
Fast forward to today, and that same building needs to refinance too. Except now, rate similar loan.
Since the pandemic, office occupancy has structurally changed. In many major cities, office vacancy rates are sitting at record highs, some north of 20%.
Emptier buildings mean lower rental income, and lower rental income means the property is worth less than it used to be. So lenders are now facing a brutal combination: buildings worth less, generating less income, needing to refinance at rates that are dramatically higher. That's the debt wall.
So what actually happens when a loan can't be refinanced? There are really only a few outcomes, and none of them are good. The borrower can pour in fresh cash to pay down the loan and make the numbers work, which many owners simply don't have.
They can negotiate an extension with the lender, sometimes called extend and pretend, pushing the problem a few years down the road and hoping conditions improve.
Or, if neither of those works, the building gets handed back to the lender, and that property becomes a distressed asset, sold off at a steep discount just to get it off the books.
And here's where it stops being just a real estate story and becomes a banking story, because a huge share of commercial real estate debt sits on the balance sheets of small and regional banks. These are the same banks that make up the backbone of local lending across the country. When commercial property values fall,
and when enough of these loans turn sour at the same time, it doesn't just hurt one bank's balance sheet. It raises questions about the entire regional banking system's stability.
The same kind of questions that triggered the regional bank stress we saw in 2023.
This is also why the Federal Reserve's rate decisions matter so much more than people realize. Every month the Fed keeps rates elevated,
so property owners can find themselves in a situation where the Fed is technically easing while their actual refinancing costs stay stubbornly high. There's also a quieter risk sitting underneath all of this: private credit. Over the past several years, private lenders, nobody fully knows how exposed these private funds are until the loans start failing, which means part of this debt wall isn't even fully visible on the radar of regulators yet.
So why isn't this the headline it should be? Because it's slow. It's not a single dramatic collapse like a bank run you can watch unfold on live television.
It's a rolling, grinding process happening building by building, city by city, loan by over years. But the cumulative effect is enormous, touching regional banks, pension funds that hold commercial mortgage debt, local tax revenue.
And that's the pattern worth understanding, because financial risk rarely announces itself with a single dramatic headline. It builds quietly in the parts of the system nobody's watching.
In loans nobody's talking about, until the math simply stops working.
The commercial real estate debt wall isn't a prediction, dud. It's already showing up on lender balance sheets right now. The only question is how much of that pain gets absorbed quietly, and how much of it spills over into the banks and institutions the rest of the economy depends on. If you want to understand where the next cracks in the financial system are actually forming, subscribe, Dad, because the real risks are never the loud ones.